Hello everyone, welcome to the 183rd episode of me learning how to trade in Forex. So in the last episode we went through selling options, some examples. So selling options, both calls and puts, is a little bit more challenging to understand than buying calls and puts options, but it can be useful for flexibility and particularly in hedging. So selling a call, also known as making a short call or written call, can generate profit when a long call, which is buying an option, will result in making a loss and vice versa. So a reason for that being options are decaying assets, so their value decays with the passage of time and they expire. So this time decay works in your favor if you're an option seller. So that's because the less time until expiry, the less chance the option has to go into the money, so the option price becomes less valuable to the holder or the buyer each day, which benefits the option seller. Short call option can therefore create limited profit in a short time, and the option seller makes a profit as long as the underlying price is below the strike price plus a premium collected. So the option buyer can profit only if the underlying price goes above the strike price plus the premium paid. So selling a call option, so this is a strategy you might use if you're bearish about the prospects of the underlying market, so you think it would fall, or if you're thinking the price was likely to stay the same. So the profit loss profile of a sold call or selling a call option is a mirror image of the profile of the long call option. So it looks like that. Went through the example. So selling a call option if you're bearish about the prospects of the underlying market, so you think it would fall, or if you thought the price is likely to stay the same. Profile loss. The profit loss profile for sell call option is a mirror image of the buy call option. So selling a call option, or okay, I guess I didn't write anything about that. So selling a call option has a limited potential risk, as the underlying price could theoretically increase to infinity. So if the market rises rapidly, you could suddenly find yourself with a runaway uncapped loss on your hands. For our rewards, the maximum possible reward for writing an option is the premium. So the seller of the call will make the premiums provided the underlying asset expires at the strike price or lower. Carefully used, this means that the sell could offer a good prospect for profit. Selling a put, so use the strategy if you had a neutral to bullish outlook for a particular market, so you thought the price was likely to stay the same or to rise. Profit loss profile for selling a put option is exactly the opposite of the profile for buying a put option, so it looks like that. For our risk, selling a put option involves substantial risk, although the potential loss isn't completely unlimited, as it is when you sell a call option. So as the market price drops, the value of the puts for the buyer increases, which isn't so good for the seller. So worst case scenario occurs if the underlying asset drops to zero, as this will give you a loss equal to the strike price minus the premium. Maximum rewards is the premium again, so yeah, the premium. And then this is a basic summary of sell call and sell puts, so what the risks are and the rewards. Then we went through the quiz and the lesson summary. So now we're on to how to sell an option in the IG platform. So as for bought options, when you sell options with IG, we don't actually buy assets or sell assets on your behalf. You're speculating on the price of the option where the price is the premium. So we'll settle your position against the value of the option based on the settlement price of the underlying assets at the expiry points. This could mean additional loss for you if the option doesn't work out as you predicted. If the option expires worthless, you get to keep all the premium. So just write the date here. 1st of July. We'll settle your position against the value of the option based on the settlement price of the underlying assets at the expiry points. This could mean additional loss if the option doesn't work out as you predicted. If the option expires worthless, you get to keep all the premium. So let's see how this works in practice. For example, suppose you want to sell an option on a stock index like the Germany 40. As with buying, you can search for your market, view the options chain and select the details you want in the IG trading platform or app. So to bring up a deal ticket, select sell for your desired option from the list. You'll see a deal ticket much like the following. The figures are example only. So this is the deal ticket here. Germany 40 11,000 put. Germany 40 13,000 put. Okay. This describes the market you're trading on the DAX. The strike price 13,000 and whether you are selling, purchasing the right to sell the underlying. Whether you are selling / purchasing the right to sell the underlying. So puts, the right to sell. Expiry date, the expiry date of the option. Underlying price, the IG price for the underlying market. In this instance, don't know why Shuck was saying that. In this instance, 15,695. So here, sell price, the price at which you can sell the option, minus 2.1%. Buy price, or no, 2.2. Buy price, the price you can buy the option, 7.2. Size, the size you want to trade. Margin, the margin you'll incur when trading the option. For buying, this is the option price, multiply your trade size. For selling, this is the underlying deposit factor times by trade size. Deposit factors are shown in our product details for each market. Resulting position, this is the total size of the trade that will be on your account. If you choose to go ahead, for example, if you had the 4 lots open, then close one, this would show +3. Place deal, if you're happy with the details, click here to open your position. Okay, so Germany 11,000 PUT. This describes the market you're trading on the DAX. The strike price 13,000, whether you're selling or purchasing / purchasing the right to sell the underlying. PUT equals the right to sell. Expiry dates, underlying price. Is this the same image as the other one? Sell price, the price which you can sell the option. Buy price, or which price you can buy the option. Size, the size you want to trade. Margin, the margin occur when trading the option. Okay, yep. Resulting position, total size, yep. Place deal, if you're happy with the details, click here to open your position. I think this is the exact same image. Okay. So what are trading costs for a sell option? When selling an option, you'll incur a margin equal to the underlying deposit factor times by size. So when selling an option, you'll incur a margin equal to the underlying deposit size, deposit factor times by size. Deposit factors are shown in our product details for each market. Deposit factors are shown in the product details. It's important to note that your maximum loss may be greater than this amount, and you may have to pay a variation margin should your positions go against you. Your maximum loss could be greater than this amount, so you may have to pay variation margin should your position go against you. If your position goes against you, your maximum profit is equal to the premium received, which is calculated like this. So your maximum profit is the premium you receive, which is size times option price so the bid price. Your profit or loss is calculated as follows. Profit or loss ratio is size times option closing price minus option opening price. So for example, say that the Germany 40 is currently trading at 11,000. You think it will stay around this level and want to sell one contract, €5 lot size. And the June Germany 40 9,000 put priced at 50.55. So that's a bid and ask price. Your margin will be stake size times by deposit factor. So €5 times by 5% times 11,000, which is €2,750. Deposit factor, I'm assuming you get that deposit factor from the product details. Premium stand to receive is €5 times by 50, so €5 times by that, which is 250. If the Germany 40 settles above 8,950, the option will be in profit. Anything below results in a loss. Break even put equals strike price minus the option price, which is 9,000 minus 50, so 8,950. You hold the option to expiry, at which point the Germany 40 is at 10500. Premium received is €250. Break even is 8,950 points. Option closing price is 0. True profit or loss equals minus €5 times by minus 50, which is 250 euros of profit, which is your premium basically. Because the German 40 price has settled above the strike price, the buyer won't exercise the right to buy, so as a seller you keep the total premium received. The margin you put down will also be released and available to place new trades. Keep in mind that when selling a put option, your potential loss is very large, so it's very important to understand the market before deciding to trade. When selling a put option, your potential loss is large. So closing your position and taking your profit. By monitoring your trade in the open positions screen, you can see the current price we're making for that option. You can choose to close the deal at any point against that price or leave the option to expiry. At expiry, your option will be settled against the value of the option as defined by the price of the underlying at that point. But as a seller, can you even close your option? Because you have to wait until expiry to see whether the buyer exercises or doesn't exercise the option, right? So how can you close the trade early though? Okay. So, are you ready to put what you learnt to the test? Log into your demo trading account to try placing a sell option for yourself. Access options markets from the Finder menu and scroll down to the list of assets and maturities. Or use the filters on the left to drill down the asset classes and maturity you're interested in. You'll see the options chain, a list of strikes, prices for both puts and calls, along with the implied volatility value. You can select different maturities and see the prices for each one. To bring up a deal ticket, select Sell. You'll see a deal ticket with details of the option you have received. You have selected, completed it, and you're ready to practice selling your first option. Lesson summary then. Remember, when you buy options of IG, we don't execute. You're speculating on the option. When selling us an option, you'll incur margin equal to size times the underlying deposit factor. Keep in mind that your losses can exceed your initial margin repayments, and you may need to pay variation margin if the market moves against you. Your maximum profit is equal to the premium you receive. Options will be cash settled expiry as defined by the price of the underlying assets at the expiry point. Your losses can exceed your initial margin payment, so you may need to pay variation margin if the market moves against you. An introduction to the Greeks. Introduction to the Greeks. The Greeks are the measures of individual risks associated with trading options, so called because each one is identified by a Greek letter. So, Greeks are the measures of individual risks associated with trading options. They're quite technical, but understanding their essential principles will help you see the risks of particular options. The main Greeks we'll be using are delta, which is the ratio that compares the change in price of the asset to the corresponding change in the price of its option. So, not delta, which is ratio which compares the change in the price of an asset to the corresponding change in the price of its option. Change in the price of its option shows how much an option's price moves for every point of movement in the underlying asset. So a delta is a measure of how movement in the underlying market will impact the price of your option, otherwise known as directional risk. So delta shows how much an option's price moves for every point of movement in the underlying asset. Delta is a measure of how movement in the underlying market will impact the price of your option. Delta shows movement in the underlying market will impact the price of your option, which is known as the directional risk. Delta is a measure of how movement in the underlying market will impact the price of your option, which is known as the directional risk. More simply, delta tells you how likely the option is to expire with any value. So delta tells you how likely the option will is to expire with any value. Delta tells you how likely the option is to expire with any value. Delta is often used in hedging strategies and is also referred to as a hedge ratio. Delta is often used in hedging strategies and is also known as the hedging ratio. Delta values can be positive or negative. The delta for a call option always ranges from 0 to 1 because as the underlying asset increases in price, call options increase in price. Put option deltas always range from -1 to 0 because as the underlying security increases, the value of put option decreases. So delta values can be positive or negative. Delta for a call option ranges from 0 to 1 as the underlying asset increases in price, call options increase in price, because as the underlying asset increases in price, call options also increase in price. So the delta is a ratio which measures the change in price of the asset to the corresponding change in its price of its option. So 0 to 1 would mean there's a greater change in the underlying asset price than the call option, right? Because if it has a delta ratio of 1, then that means as the underlying asset increases in price, the call option also increases in price by that amount. So they're always 0 to 1, they're always in, what's that word? Correlate to each other. So put option deltas are always range from -1 to 0, so delta for a put option ranges from -1 to 0 because as the underlying asset put options decrease in price. So they've got a inversely correlated relationship. So as one goes up, the other goes down. Because put option is hoping that the market price goes down. So if you have a bearish outlook, yeah, taking a short position when buying a put option, the more the price drops, the more profit you can make. So if it goes up, then not good. In the money call options get closer to 1 as their expiry approaches. At the money call options typically have a delta of 0.5, and the delta of out money call options approaches 0 as the expiry nears. The deeper in the money the call option, the closer the delta will be to 1, and the more the option will behave like the underlying asset. In the money, call options get closer to 1 as their expiry approaches. At the money, call options typically have a delta of 0.5. Delta and delta of out the money call options, out of the money call options get closer to 0 as their expiry approaches. The deeper in the money the call option, the closer the delta will be to 1, and the more the option will behave like the underlying asset. So in the money call options get closer to 1 as their expiry approaches, so the more the call option is more likely to mirror the underlying asset's increase in price. Yep. At the money call options will have a delta of 0.5, so they're not yet making a profit, so it's a bit unsure, so they're in the middle of 0 to 1. Out of the money, so you're not making any profit, call options gets closer to 0 as their expiry approaches. So 0 basically means no correlation, so they don't match up with each other at all. So as one goes up, so as the underlying asset price increases, the option price, as the option, let's just say option price increase, but the underlying asset price doesn't increase at all. So it still stays the same, so that's a correlation of 0. Get closer to 0 as expiry approaches, so the closer the expiry, the less chance the underlying asset has to move into the money, so get closer to zero basically. So the deeper in the money the call option, deeper in the money the call option, the closer the delta will be to 1, the more the option will behave like the underlying asset price. Example, say you have a stock call option with a delta value of 0.75. If the underlying stock increases in price by £1 per share, the option price will increase by 0.75 per share. Option price will be increased by 0.75 per share. Why is it 0.75? Is it because of the delta value? Stock option with a delta value of 0.75. If the underlying stock increases in price by £1 per share, your call option price will rise by 0.75 per share. Yeah, I don't really know how that works, to be honest. Vega. How much an option's price moves when the volatility of the underlying asset changes. So, how much an option's price moves when the volatility of the underlying asset changes. How much an option's price moves when the volatility of the underlying asset changes. How much an option's price moves when the volatility of the underlying asset changes. Vega represents the amount that an option contract's price change in the reaction to a 1% change in the implied volatility of the underlying asset. So Vega shows the amount that an option an option's price moves when the volatility of the underlying asset changes. Contracts price. Oh my god, I completely read it wrong. Okay. Vega shows the amount that an option's contract's price changes. Options contract's price changes in reaction to a 1% change in the implied volatility of the underlying market asset. Vega represents the amount that an option contract's price changes in reaction to a 1% change in the implied volatility of the underlying asset. Vega changes when there are large price movements, increased volatility in the underlying asset, and falls as the option approaches expiry. Changes when there are large price movements, increased volatility in the underlying asset, and falls as the option approaches expiry. Vega changes when there are large price movements, increased volatility in the underlying asset, and falls as the option approaches expiry. So Vega is how much an option's price moves when the volatility of the underlying asset changes. So if there's increased volatility, then there's going to be an increased price movement, right? So Vega shows the amounts that an options contract price changes in reaction to a 1% change in the implied volatility of the underlying assets. So how much the contract price will change when there is a 1% change in the volatility of the underlying assets. Right, okay. Vega changes when there are large price movements, increased volatility in the underlying assets, and falls the option approaches expiry. When you own options, you have a positive Vega, whereas writing options carries a negative Vega. So buying options have positive Vega, selling options has a negative Vega. So buying options has positive Vega, selling options has negative Vega. Example, say you have an option with a Vega of 2. I'm assuming there's a limit on how big the Vega can go. So as it's just a ratio, right? Say you have an option of a Vega of 2, it will move 2 points when its underlying market's implied volatility changes by 1%. Say you have an option of a Vega of 2, it will move 2 points when its underlying market's implied volatility changes by 1%. When you own options, you have a positive Vega. When selling options, you carry a negative Vega. Why do you carry a negative Vega when selling options? So when you buy options, you're hoping for volatility, right? So that there's a higher chance of you reaching in the money. And then Vega falls as the option approaches expiry, because the less time the option has, the less chance it's likely to reach that strike price. Okay, yeah, I guess, yeah. Say for an option of a Vega of 2, it will move 2 points when its underlying market's implied volatility changes by 1%. Theta. How much an option's price declines over time. Theta. How much an option's price declines over time. It can also be referred to as an option's time decay. Theta can referred as the option's time decay as an option's time decay. An option generally loses value as time moves closer to the maturity of the option. Yep. So an option generally loses value as time moves closer to the maturity of the option, because the option has less time to be able to fulfill or achieve its strike price. So an option generally loses value as time moves closer to the maturity option. Theta is a negative number and can be thought of as an amount by which an option's value will decline every day. So theta will be always negative. Theta is a negative number which represents the amount by which an option's value will decline every day. Theta is a negative number which represents the amount by which an option's value will decline every day. It's just a ratio as well. It can be referred to as an option's decay. So how do we calculate this? An option with high theta, usually one for short-term expiry, will rapidly depreciate in value as it nears expiry. An option with high theta, so high negative theta, right? So usually one with short-term expiry will rapidly decline in value as it nears expiry. So for example, say that you have a long option with a theta of minus 0.5. Is that big or is that small, that minus 0.5? Because you don't really have anything to compare it against, you know. So 0.5, the option's price would decrease by 0.5 every day that passes. Is that loads, or is that not lot? I can't tell. Note that this theta is an ever-changing number. As we approach expiry, it becomes increasingly negative, with time value decaying at a faster rate as expiry nears. Theta is an ever-changing number. So as expiry approaches, it becomes increasingly negative, with time value decaying at a faster rate as expiry nears. Lesser summary then. Wait, so ever change. So this number is always going to change. So as you get closer, I'm assuming this is not going to be a. So this minus 0.5 isn't that large. This theta will always be changing every day. It will never be the same on any days. As the expiry approaches, it becomes increasingly negative, so increasingly larger in negative, with time decaying at a faster rate as expiry nears. So as the expiry comes closer, the less value you have. Oh no, the less value your options contract is worth. I think that's what it means. Lesser summary. Delta is a measure of the change in an option's price or premium resulting from a change in the underlying asset. So delta is a measure of the change in an option's price or premium resulting from a change in the underlying asset. Vega measures the risk of changes in implied volatility or the forward looking expected volatility of the underlying asset price. Theta measures how much an option's price declines over time, its time decay. Cool. Alright. I'm going to leave this episode here then. So, yeah, in the next video, we're going to go through simple strategy 1, trading delta. Hopefully it will make more sense in the next episode, next video, next lesson, because, yeah, I don't know, I found some of the things a bit weird to get my head around, so yeah, hopefully they explain it better in the next video with some of the examples. So until next time, it will be see you later in the next video, and thank you for watching. Goodbye.